Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 15th of July 2019 and we're looking at a report published this morning stating that China's economy is growing at the slowest pace since the 1990s. We shall examine this a little closer and try and assess what this means for gold demand. China has been one of the most frequent countries we at Illuminati Silver regularly refer to. There are a number of reasons for this, not least being that 1. It's the second largest economy in the world, 2. Its currency is part of the SDR special drawing rights system, 3. It's embroiled in a major battle with the United States over trade, 4. It's one of the largest importers of gold and silver, not to mention potentially one of the largest producers too. And 5, US debt to China is $1.11 trillion as of April 2019, which represents 27% of the $4.06 trillion in treasury bills, notes and bonds held by foreign countries. Plus an array of other issues which have an impact on China's importance to both the United States and the world's economy. Anyway, it is reported today that official figures show that in the 3 months to June, the Chinese economy grew 6.2% from a year earlier, its slowest pace of growth since the early 1990s, and is 0.2% less than that reported for the first 3 months of 2019, which was 6.4%. Now, before anyone panics, it has to be said that these figures were in line with expectations, and on the positive front for China, industrial production rose 6.3% in June from a year earlier, while retail sales rose 9.8% year-on-year, both above the forecast given in recent Reuters polls. We reported only a few weeks ago that China, recognizing its growth slowdown, has already announced plans to cut taxes and boost spending, as well as reducing the amount of cash banks must hold in reserve, thereby improving liquidity within the system. We also, of course, cannot rule out any potential future interest rate cuts or further currency devaluations, if necessary. Now, many will be asking, and quite rightly, if these figures meet forecasts or expectations, then why are they worth commenting on? There are 3 main reasons for this. 1, it shows that China, while still a spectacular success in terms of growth, providing of course the figures are to be believed, are on a slowdown trajectory, a decline repeated throughout most of the major industrialized countries. 2, the knock-on effect of this slowdown could seriously impact world growth, and therefore the potential demand for gold and silver, which is of most interest to our listeners. And 3, point 2 seems to be borne out if Sharps Pixley, London bullion brokers, are correct. Let's examine what they reported on the 8th of July 2019 under the heading Laurie Williams 2019 Half 1 or H1 China gold demand, lowest for 5 years. By the way, Laurie Williams is a well-known London-based writer and commentator on financial and political subjects, specializing in precious metals news and commentary. He is a qualified and experienced mining engineer, having graduated in mining engineering from the Royal School of Mines, a constituent college of Imperial College London, recently described as the world's number 2 university after MIT. Let's quote what he writes. China has been recognized as the world's largest consumer of gold for around the past 7 years. But while the latest figures still confirm the nation as the world's number 1, 2019 demand looks to have been the lowest for around 5 years. Indeed, if the country's buying slump continues, 2019 may prove to be the first sub-2,000 ton gold demand year, based on SGE gold withdrawal figures since 2016. June Shanghai Gold Exchange gold withdrawal data certainly seems to confirm a downturn in Chinese gold demand so far this year. This should not really be too surprising given the apparent effects of President Trump's tariff impositions on Chinese imports to the US. This latest data may well give some advantage to the US in its recently resurrected trade talks with China, given that it appears the US president's tactics may be beginning to have an effect on the Chinese economy and on disposable incomes within the Middle Kingdom. But whether this is likely to be sufficient to stimulate concessions from the Chinese to meet US demands is rather less certain. There is face saving on both sides to take into account in such negotiations, and saving face is perhaps more important in Asian cultures than in the West. We have been consistent over the past few years in equating Shanghai Gold Exchange gold withdrawal data with a country's overall total gold demand, a sometimes controversial view. This data is much closer to the known levels of China's own domestic gold production, plus known and unknown gold imports, plus an allowance for scrap conversion, than are other estimates of Chinese gold consumption. These latter figures seem to ignore gold imported by the financial sector and restrict demand estimates to industrial demand, including jewellery and artefacts and investment. These cumulative figures appear to fall hugely short of known Chinese gold flows. At the half-year point, withdrawals are over 23% down on the 2018 six-month figure and over 30% down on 2017. It should also be noted that both the 2017 and 2018 full-year gold withdrawal figures ended up well short of those for the record 2015 year, when full-year SGE total gold withdrawals came to nearly 2,600 tons. Unquote. Now, the Pump has failed to mention this report. We have searched quite extensively and it's virtually unmentioned or revealed. Now, we all accept that this situation could change, and it does acknowledge that China is still one of the largest importers of gold, but one has to ask, can it continue to be if prices continue to rise and China's economy falters further? We shall have to wait and see, but it is this area that interests us most when we report on China, in addition, of course, to its trading impact on the rest of the world. That said, Sharply Pixel do end their report with the following comments, quote, "As far as global demand goes, this still remains at a high level, despite the Chinese fall-off. Indian gold demand has been showing something of a pickup so far this year, although official import figures may suffer in half 2 or H2, given the recent raised tax level on precious metal imports. This may be countered by increased levels of smuggled gold, but this would not appear in official data and thus would be invisible in national statistics. India used to be the world's biggest gold consumer until China overtook it, but remains hugely important given a national propensity to gift and hoard gold in big quantities. Anecdotal evidence suggests good continuing demand in Europe and the Middle East. Central bank gold demand continues at a high level too, so overall supply-demand fundamentals may be little affected by a fall-off in physical demand from China. However, should the Chinese demand drop be sustained, it will likely affect sentiment towards the yellow metal, so we will need to watch future month SGE withdrawal data carefully." Unquote. Sentiments and comments which we fully agree with. What's your view? Do share. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.